Hello friends, I hope you liked my earlier video on the NWP Act 1874. Feel free to drop your queries in the comment section below and I'll make sure I answer each one of it. Today I'm present before you with a completely new video. Let me share the screen for you. The topic for me today is the employer-employee insurance, an efficient tool for tax planning and employee retention. Friends, over the almost 5 years back, this insurance scheme was not very popular, but over the years, this scheme has become extremely popular among, especially among the corporates, non-corporates, and even for small and medium-sized firms. They use it as an excellent tool for planning their taxes and retaining their talented employees. How does this scheme work? What are the process? What are the benefits? What are the requirements? What are the eligibility criteria? The entire thing will be discussed by me in detail in this video presentation. I request each one of you to kindly stay with me till the end of the presentation. Let us begin with a brief concept. Under employer-employee insurance scheme, the organization or the employer purchases life insurance on the life of the employees. In case of any circumstances leading to the death of the employee during the tenure of employment, the company receives the maturity proceeds from the insurance company and transfer the proceeds to the family members of the employee. It is a unique opportunity for the employer to reward his or her employee and get benefited at the same time. In the EE insurance arrangement, both employer as well as the employee is benefited at the same time. Friends, this is in a nutshell. We'll be discussing each and every point in detail in the upcoming slides. So let us proceed with the eligibility conditions. The employer-employer relation should be substantially established. The employer and the employer should submit the Form 26AS, the Form 16, pay slip, salary slip, etc. to substantiate the relationship of employee and employer. All individual insurance plans are available under the scheme. The amount of insurance coverage will depend upon the age and income of the employee. Premium payable by the employer will also be considered as income for the purpose of deciding the coverage of insurance. This is important, so let me elaborate it. Premium payable by the employer will be treated as perquisites in the hands of the employer under Section 17, subsection 2, clause 5 of the Income Tax Act, and accordingly it will be added to the total income of the employee. Thus, premium payable by the employer will also be considered as income for the purpose of deciding the coverage of insurance, since it gets included in the total income of the employer. Okay? Moving on, employer has to assign the policy in favor of employee within a reasonable time. Friends, I have prepared a completely different slide related to assignment. I'll discuss the fifth point in detail when I come up to that slide. Moving on, how does the EE insurance works? Let us see. The employer can purchase an insurance policy for the employee in either of the two arrangements given below. Let us look at the arrangements. We have type A, where employer is the proposer and employee is the life insured. We have type B, where employee is both the proposer and the life insured. Under type A, employer proposes the policy for the benefit of the employee. And under type B, employee is both the proposer and the life insured. Let us analyze both the types, type A and type B. The premium is paid by the employer in type A until the policy is assigned to the employee, usually within a specified time period. We all know that under type A, the employer is the proposer and the employer is the life insured. So the employer needs to assign the policy to the employee within a pre-specified time period. The premium before assignment is to be paid by the employer. The employer, however, can continue to pay the premium even after assignment if he wishes. Otherwise, the premium payment has to be continued by the employer. The maturity amount or the death claim shall be available to the employee or the nominee, as the case may be. In case of maturity, it shall be payable to the employee, and in case of death, it shall be payable to the nominee, if the policy has been assigned to the employee by the employer. If the policy has not been assigned, then the maturity amount or the death claim shall be paid to the employer, who will then transfer it to the employee nominee, as the case may be. Under type B, question of assignment does not arise, since employer is both the proposer and a life insured. Since the employer does not have any control over the situation in type B arrangement, usually type A is preferred EE insurance arrangement. Mostly we see practically type A is the most common form of EE insurance arrangement, because the employer does not want to lose their control over the policy of its employees. So they prefer type A. Moving on to the most important aspect, which is the tax implication. Let us discuss in detail. Before assignment, as we know, employer is the absolute owner of the policy. Premium paid are deductible expenses for the organization under Section 37, subsection 1 of the Income Tax Act. These are allowable expenditure under Section 37, subsection 1. Section 80C benefit shall not be available to the employee on the premium paid by the employer. Maturity proceeds, death claims received by the employee shall be included in the total business income of the employer in the year of receipt. Friends, note, we are talking about the cases that will occur before assignment. Moving on, after assignment to employees. We all know employee becomes the owner of the policy after assignment. The sum total of the premium paid by the employer before assignment is treated as perquisite as per Section 17, subsection 2, clause 5 of the IT Act, as we have discussed it earlier, and will be added to the taxable income of the employee in that financial year. Premium paid by the employer after assignment is treated as perquisite in the financial year and will be taxed accordingly. Employee can claim deduction under Section 80C even if the premium is paid by the employer. So, in short or in a nutshell, before assignment, 80C deduction is not available to the employee. After assignment, 80C deduction are available to the employee even if the premium is paid by the employer. Let us analyze different scenarios. What happens if the employee quits job before assignment? Employer can either surrender the policy and get the surrendered value, or absolutely assign the policy to the employee as part of his terminal benefits. There are two options available to the employer. He can either surrender the policy and get the surrendered value, or he can absolutely assign the policy to the employee as part of his terminal benefits, and the employee will continue to pay the future premium if he so desire. What if the employee dies before assignment? Well, then the death benefit has to be passed to the nominee of the employee unless it is specifically mentioned in the agreement. What if the policy matures without being assigned to the employee? Maturity proceeds in that case shall be received by the company or the organization. It will be treated as income of the company and will be taxed accordingly, and tax shall be deducted at source. Here, let us look at the scenarios after assignment to the employee. What if employee quits the job after assignment? Employee is the owner of the policy. We all know after assignment, employee becomes the owner of the policy, and he should pay the future premium, if any, and can enjoy the maturity proceedings. Maturity amount will be tax-free under Section 1010D of the Act. In case of death of employee after assignment to the employee, death benefit shall be paid to the nominee of the employee and shall be tax-free under Section 1010D of the IT Act. What if the policy matures after assignment to the employee? Maturity amount received by the employee shall be tax-free under Section 1010D of the Act. So, in any case after assignment, the maturity proceeds will be tax-free under Section 1010D of the Act. Moving on, why employer-employee insurance benefits to the employees. Here are some of the benefits. Offers sense of financial security for the employees, will provide income to the family of employees in case of premature death. Benefits of this policy can be used as funds for retirement. The employee gets benefits which are tax-free. They enjoy the benefits of this cover without paying for the same. We all know that before the policy is assigned, the premium is paid by the employer, and also in other cases, even after the policy is assigned, the premium continues to be paid by the employer. So we can see that the employer can enjoy the benefit of this cover without paying a single penny for it. Moving on to the benefits to employers, this kind of arrangement helps in developing employees' loyalty. Employees' loyalty towards the organization, towards the employer, is developed to a great extent because of this kind of arrangements. Minimizes employees' attrition rate. By attrition rate, we means the employee's turnover rate, or the rate at which the employee retires, or the employee vacates his office or leaves his job. Tax rebates on premium paid. We have already discussed the benefit that are available to the employers in form of section 37 subsection 1. Attractive option to retain talented employees. This is an excellent tool to retain talented employees. Additional time and financial cost incurred in recruiting and training new employees can be avoided by retaining current employees. Output of employees increases significantly where fringe benefits like these are provided. Without any doubt, output of employees increases manifold due to this arrangement. Moving on to the requirements. Medical requirements, it depends upon the age and sum assured of the employee. Financial requirements, the following documents are required: salary slips, pay slips of Form 16, income tax return of employees, copy of MOA, AOA for companies, partnership deed for partnership firm, any other registration certificate for any kind of other proprietorship firms, board resolution, declaration by organization, KYC of both employer and employer. These are some of the most common documents. The other documents may vary from company to companies. Well, that was all from my side. I hope you liked the presentation. And in case of any question, you can find me at the below mentioned email IDs and Facebook links. You can also drop me all your queries in the comment section below, and I'll be more than happy to answer all the queries. Thank you. Stay safe, stay indoor, and stay